this year was sort of characterized with a lot of clouds on the horizon. You've said that as the year has gone on, those have cleared up. Kind of what is the outlook going forward? What are you seeing in the next couple of quarters?
Well, it has been a very sort of interesting, in some ways mixed environment this year so far, but one that I think we've been trading through quite well as an organization. You know, we're delivering revenue growth, 11% on the top line. We're executing on our expense agenda, and that's helping us to deliver operating leverage. We had 3 positive ratings actions in the quarter, and we're delivering on our capital return story, having announced a $450 million buyback yesterday. So we think in this environment, the profile we're putting together is pretty strong.
And getting into kind of the specific silos of that business, trading was always going to be tough this quarter. We've seen that across the industry. It's actually come in a bit better than you had guided towards. You said that there's going to be a bounce back in the second half. What does a bounce back mean, and are you seeing it already now that we're in the third quarter?
Well, I'd say 2 things. One is we came in down 10% off a really good quarter last year. So we think a decent performance in this environment. Volatility has clearly declined versus where we were last year. Again, last year was the war was still sort of in the markets and the uncertainty about the energy path. We've gotten to a place now where I think the market sees the forward on interest rates. Mm-hmm. And you know, we do see the potential for a pickup as we get into the sort of the downside of the cycle, if you like. You know, as investors start to position for the timing and the extent of policy rate declines. I think that's early yet, but it's something that we do believe lies ahead. And
in terms of the revenue outlook, what is that looking like for the rest of the year? Are you confident in kind of guiding either higher or towards the upper end of your range for the rest of the year?
Well, look, so first of all, in our range, which we said at the beginning of the year, 28 to 29 billion, we're now saying that we think we're solidly in the middle, probably the upper end of that range, which is really encouraging. Now, of course, a lot of that story this year in the banking industry, not just Deutsche Bank, has been a rate story, and that's not just the rate rises, but also questions about you know, deposit rate pass through into the for the banks. You know, what's interesting, and especially for us, given our sort of business profile, business mix, we do see as that rate story abates somewhat, it's normalizing, and it'll normalize, I think, at a healthy level. We think there's a story developing in terms of the non-interest income revenue sources that we have. You know, financial markets over the past 4 or 5 quarters have been sort of more difficult, but we see that starting to come back, and we think we're very well positioned to take advantage of that.
And if things have gone a little bit better in trading than we had anticipated, you know, rates maybe topping out a little bit. Going forward, where do you think the growth really comes from? What parts of the business are really going to drive growth?
Well, look, there are parts of the investment world that have been quite difficult. I'd take wealth management as an example, where investors have been sort of reticent. To your point earlier, you know, in the uncertainties that have lain ahead, whether it's the rate, the direction of the economy, some of the geopolitical events that we've been living through, as those things clear up and the direction of travel becomes more clear, you'd expect that individual investor, that wealth investor, to begin to re-engage. The other area, by the way, corporate finance activity, been notably slow over the last 4 quarters, and we do expect that to pick up as well.
And that all to do with the ECB. So, you know, the market is priced in 25 basis points. Are you with the market?
Yeah, we agree with the market that both the Fed and the ECB are likely to move by this week, the 25 basis points. Question of what the step after that is. Our sense is that the ECB may have one more move to make, and that the Fed may stay pat. You know, to us, the real question now isn't what's the terminal rate, but how long will it persist for? How long will it take to wring core inflation out of the system? I think that's the question that's still outstanding.
And at what cost, I think, is the other one. We saw yesterday the ECB saying that corporate loan demand is off of a cliff. You know, we've had manufacturing in recession, quarter of SMEs, according to surveys, saying that they're considering packing up and selling. You are the lender to Germany Incorporated. What are you seeing in the economy?
Well, look, I think let me start with the case for a soft landing, and I have to confess that we were sort of more pessimistic in our outlook at the beginning of the year, but the case for a soft landing seems to be improving. That entails, though, and that's what the central banks have to achieve, is that there is some slowdown in the economy. And the mechanism for putting the impact of policy rates through the economy is bank lending. And while you've seen a decline in Europe and also in the U.S., and you've seen that in our books, so loans are down in certain of our businesses, I'm not sure it's a dramatic or a long-lasting impact that's likely to take place. I think there's an adjustment to this rate environment, and then we'll find a level and begin to grow from that level.
But we noticed sort of a large, or a kind of at least notable increase in provisions in kind of this quarter. What are you kind of expecting there? Are you expecting kind of that portfolio to soften a little bit? Like, what are you seeing?
Look, we have seen some softening, but it's not at all broad-based, and so we're still basically comfortable with the credit environment that we're living through. As I say, there have been some pockets. Commercial real estate has been an area of focus. We've seen some softening in our home economy in the mid-cap space. But it remains sort of pockets of weakness and nothing that we see as more pervasive.
And I want to touch the buyback as well, $450 million, as you had sort of steered the market. The market got that information, and so, of course, the market wants to know what comes next. And obviously, this is part of a broader plan from Deutsche Bank to give back some money to shareholders. Can we expect this as a kind of less of a one-off and more of something that we build in, and can we expect increments of that kind of quantity, 150 million, something like that? What are you seeing for that, the plans for the buyback?
Well, I guess two things. First of all, we've been very clear about our goal to return $8 billion over 4 years to our shareholders. And so with the buyback announcement yesterday, we have another installment, and we're pleased to have taken that step. We've got a very clear dividend policy or path that we laid out in March of last year, a 50% increase per year over several years, bringing us back to a much more normalized and at this level, I think, very competitive dividend yield. Obviously, share repurchase are a big part of our return story as well. And so this year we've been able to keep pace 50% higher than last year's repurchase. And too early to say what we'll do next year and the years after, but we aim to continue on this trajectory and deliver on that $8 billion.
And then in terms of cost cuts, obviously this is the other long-term project for Deutsche Bank, is getting those costs down. We saw some of them come up this quarter, some one-off. But then one of the things that grabbed my attention, 100 million annually in savings on job reductions. Let's put a little bit of some contours around that. What does that really mean? Sure.
Well, listen, it's part of a program. What we said last March was we want to deliver $2 billion of savings based on some programs and initiatives that offset the impact of inflation, the impact of investments that we need to make. We actually upped that target to $2.5 billion just recently in April, and we're working on measures and delivering on measures that achieve that for us. As you say, a reduction in force was part of that. 5% of what we say is non-client facing senior staff amounts to about 800 people. And we've made really good progress on that. So a little over 80% of those people have either been informed or have left the platform. And that should add, towards that goal of $2.5 billion, about 100 million into the run rate by the end of the year. I think the important thing is just how we execute on these saves and essentially balance saves with investments that we know we need to make. We've been working hard on our control environment, hard on sort of renewing the technology estate that we work with, and also investing in the businesses for future growth, and working therefore hard on delivering these initiatives to offset those pressures. We've delivered now 3 quarters in a row against the guidance that we had of essentially flat costs, 4.9 billion in run rate sort of operating costs. That's something that, looking towards the end of the year, we would see increasing a little bit as we bring Numis on board and see the impact of some of the first the frontline investments that we've been making. But we're very confident about our delivery on those savings initiatives. It feels a little bit as though we're starting to run downhill, if you like, with the delivery giving us sort of more confidence in our momentum there.
And do you think that combination is the recipe to kind of help with, for example, the valuation of Deutsche Bank and kind of getting more of the value?
Absolutely. For us, it's an operating leverage story. We've now delivered over the last 4 years pretty consistently 5% operating leverage year on year, quarter on quarter. And if you take out the non-operating sort of higher than normal litigation charges this quarter, on an underlying basis, that's again what we're doing. Our revenues are growing ahead of our plans, and as we deliver on the expense agenda we have, it produces really strong operating leverage.
And more broadly, kind of on the macro, in the second half of the year, are there reasons to be kind of optimistic within the German economy? You know, again, we've been awaiting the tailwind of the great China reopening story, where you have stimulus coming into China. But is there a reason to be optimistic? Kind of where
I think there is.
Yeah.
Look, it's sort of a mixed picture, as I said earlier. But in part, what I mean there is, Germany and Europe more broadly has been somewhat stagnant in terms of its growth these past several quarters, sort of at around zero. We do expect that to be a little better in the second quarter, but what you're seeing is the effect of certain sectors, so building, for example, and real estate being in a recessionary territory. Other sectors like services, growing quite strongly. So there's a mix going on. And to your question, what is the dynamic going forward of recovery in those areas that are recessionary? What's going to happen with sort of the industrial order books and the export market? All of those things are in play, but I think the conditions are in place to see sort of steady growth starting, either late this year or into 24.
And just very quickly, because we have not much time left, when we just think about the balance of risks for clients, what are they most worried about now? Originally, is inflation, then recession, then kind of geopolitics. What do you think is the kind of guide right now is preoccupying?
Look, I think geopolitics is front and center. I think, as I say, I think the direction of rates probably more clear. People are getting more comfortable with the direction of the economy, and that really leaves sort of geopolitics as the big unknown that we're dealing with. So as more of these clouds begin to clear, as I say, the conditions are there for a growing economy and a normalized rate environment, which should be good for the banks.